Hello, my dear future charters. Welcome to paper discussion series by More Academy. Hope you are not tired after the lengthy and little tedious question of NPO. Now, before going ahead with the discussion of question number 4b on partnership, let me give you a small reminder to like and share these videos and subscribe to this channel to get notifications of the new video alerts. I am Professor Anand More, your guide for CA career, and in this video, I'll be discussing question number 4b on admission of a partner from the exam paper of December 2021. Question number 4b. A and B are partners sharing profits and losses in the proportion of 3/4 and 1/4. As on 31st of March 2021, following is the balance sheet of A and B. Balance sheet as on 31st March 2021, capital accounts of A and B 2,85,000 and 1,55,000. Total is 4,40,000. Creditors 3,75,000. General reserve 60,000. On the asset side, we have cash in hand, cash at bank, sundry debtors, stock, bills receivable, land and building, and office furniture. The adjustments state they agreed to take C in partnership on 1st April 2021 on the following terms. Goodwill is to be valued at rupees 2 lakh. C is unable to bring cash for his share of goodwill. So it was decided that due credit for goodwill be given to A and B for their sacrifice in favor of C through C's current account. C pays rupees 1,40,000 as his capital for 1/5 share in future profits. Stock and furniture to be reduced by 10%. A provision of 5% for doubtful debts to be created on debtors. Land and building to be appreciated by 20%. Capital accounts of the partners be readjusted on the basis of their profit sharing arrangement, and any excess or deficiency is to be transferred to their current accounts. Prepare revaluation account and partners capital account. This question was asked for 10 marks. Now, just like our usual practice, let us first of all go for checking the observations, discuss the problem properly so that solution will be easy for us. The first observation is that A and B are the existing partners in 3:1 ratio. 3:1 is their old ratio. C is a new partner who is admitted for 1/5 share. Now new partner share is given, but the sacrifice made by the old partners is not given. It implies that the old partners must have sacrificed in their old ratio. Hence, the sacrifice ratio and the old ratio must be same, that is 3:1. And accordingly, the new ratio would be 3:1:1. So old ratio was 3/4 and 1/4, and new ratio is going to be 3/5, 1/5 and 1/5. Now C is unable to bring his share of goodwill in cash. The entry for goodwill is expected to be made through partner's capital account. However, the problem has given clear instruction that the entry should be made through C's current account. Accordingly, C's current account will be used along with A and B's capital account for making the entry for adjustment of goodwill. The problem has given value of firm's goodwill. Adjustment number 1, goodwill is valued at rupees 2 lakh. So that is firm's goodwill. However, we always need the share of new partner in the firm's goodwill. Hence, the value of goodwill of the firm, value of goodwill for the purpose of adjustment would be 2 lakh firm's goodwill into 1/5 C's share is equal to 40,000, and it will be distributed to A and B in their sacrifice ratio, which happens to be equal to their old ratio, that is 3:1. Capital brought in by C is clearly given as rupees 1,40,000 in adjustment number 2. Reduction in stock and furniture is expected to be done by us. Further, we are required to create RDD. All these three adjustments are basically losses, hence they will be debited to revaluation account. Whereas the next adjustment, adjustment number 5, land and building to be appreciated, it means it's a profit for the firm and it will be credited to the revaluation account. Now the problem has given instruction to bring capital in PSR. So capital must be maintained in PSR after admission of new partner, that is C. However, the basis for the same is not given. Hence, incoming partner share, that is new partner share, that is C's share, is taken as a base to determine the expected balance of old partners. Now C's share in capital is already known to us. Adjustment number 2, it is rupees 1,40,000. 1,40,000 is for 1/5 share. Then what must be the capital for 3/5 share of A and 1/5 share of B? This is the simple calculation to be made. Now very important point to be noted is that the problem has not asked you to prepare balance sheet. So it's quite an easy problem. We are just required to show the calculation of ratios, calculation of capital, adjustment of goodwill, and then revaluation account and partners capital account. Although an adjustment is expected in current account, the problem has not asked you to prepare current account. So it's quite an easy problem. We can solve it hardly in 15 minutes. Let's go ahead. Now remember, when you are preparing the solution in the examination, the main solution should be always appearing first in your answer, and the working note should be always coming after the main solution. Now since I'm supposed to discuss the working notes, discuss the entire solution, that's why I'm showing the working notes first. But when you are preparing the answer, please remember that your main answer should be appearing first in the solution and then the working note should come. So please leave almost half a page for the purpose of revaluation account and half a page for the purpose of partners capital account. Partners capital account should be in columnar manner, that is particulars ABC on debit side and particulars ABC on credit side. Half page for revaluation account, which is expected by the problem, and half page for partners capital account, which is again expected by the problem. Revaluation account is a normal ledger account, particulars amount, particulars amount. Whereas partners capital account is a special ledger account. It will have 3 columns on the debit side for amount and 3 columns amount credit side also. So particulars ABC on debit side and particulars ABC on credit side. After leaving those half page formats, let us now prepare the working note. Calculation of total capital of the firm. Now the solution which is given by institute is little lengthy solution. We can make it a very simple solution. For 1/5 share, C is bringing 1,40,000. And B's capital is also, or B's profit sharing is also 1/5. That means his capital should also be 1,40,000. So expected closing balance of C is already known to us 1,40,000. Since C's share and B's share is appearing to be same, it is obvious that B's capital would also be 1,40,000. Expected closing balance of B's capital 1,40,000. And A's capital, since A's PSR is 3/5, it will have to be 3 times the capital of Mr. B or Mr. C. So 1,40,000 into 3, that comes to 4,20,000. So we already know now what is going to be the closing expected capital of all the 3 partners. Mr. A will be 4,20,000, 3 times C. Mr. B will be 1 time of C, that is 1,40,000 same, and Mr. C is given by the problem 1,40,000. Next, calculation of ratio. Again, institute has given a lengthy solution. You can make it very simple since the new partner share is given and sacrifice made by the old partners is not given. It means old ratio must be equal to sacrifice ratio. So old ratio is 3:1, sacrifice ratio becomes 3:1, and new partner share is 1/5. So in that case, the new PSR also becomes 3:1:1. Institute has given one particular format. You can check that format, pause the video, check it out, you will get the same answer. Sacrifice done by A and B is 3:1 and gain made by Mr. C is 1/5. Let us go ahead with the next part. Goodwill adjustment. We have already discussed that 2 lakh is the value of firm's goodwill. Whereas for the purpose of adjustment, we don't require firm's goodwill. We require only the value of goodwill which is to be shared by Mr. C. C's share in goodwill is 1/5. So 2 lakh into 1/5 is equal to 40,000, which is to be adjusted through C's current account. Why current account? Because it's a clear-cut instruction by the problem. If the problem would have been silent, then I would have adjusted it against C's capital account. Since the adjustment is clear that the adjustment should be made through current account, that's why we are using C's current account, but A and B we are going to transfer it to their capital account. So C's current account will be debited because he is supposed to bring in goodwill. He is not bringing in goodwill. So we are going to specify that we gave you goodwill. You are going to enjoy the reputation of the firm. This reputation was created by A and B. So A and B are the givers of reputation to Mr. C, who is not paying anything just now. So it is just like credit sale. When we sell the goods to somebody on credit, the entry is customer account debit, debtor account debit to sales account. If it is on cash basis, then it is cash to sales. If it is on credit basis, then customer to sales. Similarly, here who are the givers? A and B are the givers. They have worked hard for the purpose of developing the reputation. and that reputation is now going to be shared by C. So C is the receiver of reputation, A and B are the givers of reputation. Debit the receiver, credit the giver. Entry will be C's current account debit to A's capital account to B's capital account. It will be in their sacrifice ratio, which is 3:1. So 40,000 C's share in total goodwill to be distributed between A and B in their sacrifice ratio 3:1. So C's current account debit 40,000 to A's capital account 30 to B's capital account 10,000. Now all basic adjustments are already seen by us. We have prepared the working notes also properly. We can go back to that blank format which we had already prepared. Half page for revaluation account and half page for partners capital account. Revaluation account, just a normal ledger account, particulars amount and particulars amount on debit and credit side. Whereas partners capital account will have 3 columns of amount on debit side, particulars ABC, and 3 columns of amount on credit side, particulars ABC again. First, we are going to consider the balance from the balance sheet. The balance from the balance sheet is partners capital account 2,85,000 and 1,55,000, which will be returned to the partners capital account credit side by balance brought down 2,85,000 and 1,55,000. There is a general reserve given to us 60,000. This general reserve is representing the old undistributed profits of partners. So it should be given only to the old partners, that is to A and B, in their old profit sharing ratio, that is 3:1. So we are going to transfer general reserve of rupees 60,000 in the ratio of 3:1 to A and B as rupees 45,000 and 15,000. Now all the adjustments of balance sheet basically are over. Let us now consider the adjustments which are happening on account of admission of Mr. C. On account of admission, we are going to do the revaluation. They have told that stock and furniture to be reduced by 10%. So the value of stock is rupees 2 lakh and value of furniture is rupees 10,000. So 2 lakh and 10,000 both to be reduced to the extent of 10%. So automatically furniture value will be 1,000 and stock value will be 20,000. It's a reduction. Reduction is a loss. Debit all expenses and losses. Revaluation account is a nominal account. That's why it will be debited by the amount of loss on furniture and by the amount of loss on stock, which is 10% of their old balance sheet value. The problem also tells you to create RDD at the rate of 5% on debtors. The value of debtors is rupees 1,60,000. So on 1,60,000, we are supposed to create 5% RDD, that comes to 8,000 rupees. RDD is a loss, so it will have to be debited to revaluation account debit to RDD or provision for doubtful debts. Then there is appreciation in land and building, which is a profit to the extent of 20%. The old value of land and building as per balance sheet, second last item on asset side, is rupees 2,50,000. So 2,50,000 into 20%, that comes to 50,000 to be credited to revaluation account. Now all the adjustments of revaluation are over. Let us take the total of the same. Find out the balancing figure. The balancing figure is 21,000. Revaluation profit represents the profit on account of old partnership. So it should be given only to the old partners in their old ratio. Old ratio was 3:1. Accordingly, 21,000 is divided between both the partners, old partners A and B, in the ratio of 3:1, 15,750 and 5,250. These two things are credited to the partners capital account. Then we are going to ask Mr. C, please bring in your capital. He's giving rupees 1,40,000. So entry is cash or bank account debit to partners capital account or C's capital account. Then we are going to ask him, please bring in your goodwill. He is not in a position to bring goodwill. So we are going to tell him that the adjustment will be made through your current account. So C's current account will be debited. Now we have not prepared the current account here. We have prepared only the capital account. So current account debit of Mr. C, that effect of debit cannot be shown here. The problem has asked us only to prepare the capital account, not the current account. Hence, I cannot show the debit effect which is given to C's current account. But I can show the credit effect which is given to A and B's capital account, which is 30,000 and 10,000. Name is by C's current account into bracket goodwill. Once all these different things are over, then we can consider the closing balances. We have already decided the closing balance is going to be 4,20,000 for A, 1,40,000 for B and 1,40,000 for C. Once the closing balances are written as per the working note, then we can take the total, find out the balancing figure. If the balancing figure is coming on debit side, it will be transferred to current account. If it is coming on credit side, it will again be transferred to current account, because that is adjustment, that any excess or deficiency in capital account should be transferred to current account. Accordingly, A's capital, there is a difference on the credit side, 44,250. It will be credited to A's capital, that means debited to A's current account. And 45,250 is debit to B's capital, That means it will be credited to current account. Since current account is not asked, since closing balance sheet is not asked, that's why those two different things are not prepared and the problem is over. So very simple question, 10 marks in your pocket. I'm very sure now that you are ready to complete last question of 20 marks and complete your entire paper. So in the next video, I'll talk about question number 5. See you in the next video.